This is On The Charts with Nick Radge, your Australian stock market update, highlighting stocks on the move so that you can invest with confidence and success.
The information in this podcast is general advice only and does not take into account your personal situation. Please consider if it is appropriate to you and consult a licensed professional before making any investment decisions. The information provided is believed to be accurate at the time of recording.
Welcome to the On The Charts podcast, episode 196 for Tuesday, 16th of May, 2017. Today is day 2 of Big Picture Week, where we take a look at the very long-term technical outlook for Australian and international markets. Yesterday, on day 1, we looked at the All Ordinaries and 2 of the biggest blue-chip names in Australia. And while both were compelling, one in particular stood out as a fantastic long-term opportunity. Today, we also dive into a few international markets as well, so be sure to jump on board. Head over to thechartist.com.au and take the 2-week trial and get immediate access. US stocks closed at record highs last night after oil jumped some 2%. Large caps such as Johnson & Johnson and Cisco Systems helped both the S&P 500 and Nasdaq to new records. The oil price move occurred after major funds had been liquidating long positions over prior weeks, and prospects for an OPEC deal for continued production limits firmed. Most base metals rose in London, as did iron ore. In Australia today, the market made early headway, even in the face of the National Australia Bank and Macquarie going ex-dividend, but gains yet again failed to stick. Other banks were holding minor gains, but barely enough to keep the market in the green. The RBA issued its minutes from its May meeting, and all members remained firmly on hold, with rate adjustments citing ongoing concern about household debt levels, a weak labour market and soft wages growth. Nothing we haven't heard before, and a key reason why the ASX really can't get a leg higher at the moment. As mentioned, the big weight on the local market was National Australia Bank, down ex-dividend 3.6%, and Macquarie Group, which also lost 2% ex-div. On the day, the broader market closed about 0.2% higher. Taking a look at a few individual stocks, ServiceStream is a utilities and telcos contractor and responsible for the NBN rollout. The company operates in various sectors, including mobile and fixed communications, electricity, water and gas infrastructure. It provides access, design, build and installation of essential networks and manages some 6,000 mobile phone sites and visits some 32 million properties a year. The company recently proposed a $20 million acquisition of TechSafe, the largest independent electrical inspection company in Australia. The NBN activations will not likely peak until mid-2019 and could extend 3 to 4 years past that date. Because of this exposure, the company is deemed a key contractor and has much better prospects than their peers. Technically, the stock has been consolidating since last October and has today broken out to new all-time highs. The trend into this consolidation has been nothing short of impressive, and this break higher may well be the start of a long-awaited continuation of that trend. That said, the pattern at hand is more of a traditional ascending triangle, and these traditional style patterns tend to have a retest or a revisit of the breakout, if you like, before moving on. This retest can spook weak holders out, but can also provide a much lower risk entry point to initiate new positions. Today's closed is deemed a little weak, so it appears some sellers are still distributing the stock, so expect a little more posturing before moving higher. Upside target is $1.70 should the trend kick on. And primary healthcare has started making upside headway, closing 2.1% higher today at $3.85. The company is a leading medical centre operator with 72 centres across Australia. It also operates 107 pathology labs and 2,207 collection centres and is Australia's largest pathology business. It's also Australia's second largest diagnostic imaging network, conducting some 3 million radiography examinations per year. The removal of the freeze to the medical benefits scheme is deemed a positive for the sector and should alleviate the need to move to private billing. These benefits, however, may not flow through to financial year 2019. Technically, the initial view of the chart suggests the stock has been stuck in a range since early 2016, between 325 on the downside and 425 on the upper. From our perspective, this has been part of a broad pattern that is completion of a larger move higher. Whilst not textbook, it does fit the criteria and does bode well for further upside, especially if that upper boundary can be overcome. We'd expect this current strength to continue towards 425 level before a minor pause takes hold, although ideally we'd like to see the pause above the resistance level. Eventual upside target is $6, but we're wrong below $3.50, so it does offer a very strong risk-reward opportunity right here. My name's Nick Radge. Don't forget, today is day 2 of our Big Picture Week. You can sign up at thechartist.com.au, and I look forward to seeing you on the charts tomorrow.
On the Charts with Nick Radge, brought to you by The Chartist. Join Nick and the team at Noosapalooza Trading and Investment Conference, 20th and 21st of July in beautiful Noosa, Queensland. Visit thechartist.com.au and click on Noosapalooza in the menu for details.